this is Nikhil Dhawan from Los Gatos. Today we are going to chat about the credit score or the dreaded FICO and its impact on mortgages. Since the advent of FICO scores, which were intended to measure credit worthiness, the industry has come to rely on specific thresholds to make various types of loans that we are going to be discussing today. Before we proceed, there is one question I get asked every time from a home buyer, and that is if they already have a pre-approval with a lender, will their credit get hit if they go shopping for a loan with another lender? The answer to that is simple. If you do it within 45 days, it will not affect your score, but after 45 days, it will, but to a lesser extent. Let's start by talking about the different grades of credit scoring. 850 is obviously the highest score you can achieve, but a score of 770 to 780 should be your ultimate goal. From 680 to 779, it is considered low risk, but has different ratings like A+, B+, etc. And from 580 to 679 is considered medium risk. 579 and below is considered high risk. I would also like to add how banks assess risk and assess individuals as a group. As a group, the consumers in the 700 to 749 range, as an example, have a delinquency rate of 5%. This means for every 100 borrowers in this range, approximately 5 will default on the loan, file for bankruptcy, or fall 90 days past due on at least one credit account in the next 2 years. Next, we are going to talk about what information creates your FICO score. As you can see on this chart, 35% is based on your payment history, 30% on the amount of debt you hold, 15% on your credit history, 10% on you getting a new credit card or any other new credit, and another 10% on the different types of credit you hold. Let's talk about the payment history at 35%. You essentially need to remain current on paying all your monthly bills. Any new late payments or bad debt charge-offs can lower your score by as much as 100 points. Even one late payment of $5 can cost you. Mind you, the lower the minimum payment that is due, the further your score will drop, as it assumes that if you can't even make a $5 payment, you are in serious jeopardy. So please be careful of that. Coming to the amount of debt at 30%, there is a 30% rule on credit card balances, which means that you should not spend more than 30% on your credit card limit. So as an example, if your credit limit is $1,000, your spend on a monthly basis should not be more than $300. Looking at the length of credit history at 15%, this looks into how long your revolving accounts have been open. For new credit at 10%, it's important you know this, but by opening a new account, including cell phone or cable, that can potentially lower your score for 12 months, while new inquiries can lower your score on an average of 5 to 22 points. Lastly, let's look at the types of credit at 10%. This type talks about the hierarchy of the types of credit, namely mortgages, which has the biggest amount of weight, auto loans, bank credit cards, store credit cards, and finally other installation loans such as student loans. It's important to note that a mortgage loan carries more positive points after being open for greater than 12 months compared to any other types of credit. Please like and subscribe to YouTube to keep my channel going. I hope you found this information informative, and feel free to reach out to me today to answer any of your real estate related questions. Thanks for watching.